Good morning. My name is Gavin Smith. Thank you for joining me today to have a look at Apple. So I'm going to start off with the nature of the business, and then move on to the recommendation, the financial review, the divisional review, the company guidance, and lastly our portfolio guidance. So iPhone is the largest part of Apple's revenue stream. It makes up around 62% of revenue. The nature of this business is inherently risky. This is because the product life cycle is quite short, meaning you're only going to keep your iPhone for 2 or 3 years before replacing. At this point, you're at risk of losing a customer to a competitor. This competition is amplified by the rapid change in technological advancements in this space. We have seen this happen before with the likes of Nokia, Motorola, and more recently BlackBerry. Traditionally, mobile phones have low switching costs, meaning there's not much stopping a customer from moving to a competitor. However, the strength in Apple's business model, in our view, comes through its services and other products. This really underpins the investment case and has been an area where the company has seen the strongest growth over the past year. What this does, in addition to being alternative revenue streams for the group, is create an Apple ecosystem. This builds brand loyalty, and with lifestyles becoming integrated into Apple products, there's less likelihood of a customer rather going for, let's say, a Samsung or Huawei device when the upgrade becomes due. Therefore, we can be more confident that the iPhone business will provide more of an annuity type income stream. The services business contributes 13% to revenue. This business includes digital content, being Apple Music, movies, and so on, as well as iCloud. Once your personal content and music purchases are only available through Apple devices, it becomes a lot harder to switch. The services business also includes the App Store. Support from third parties and developers is very important in this business. If you think of the Discovery Vitality platform and how this becomes entrenched in your lifestyle. You can see this benefit for Discovery with their client retention rates, and then this also becomes an asset for Apple. Other products, which makes up 6% of revenue, includes the Apple Watch, Apple TV, iPod, accessories, and AirPods. The Mac or the PC business makes up 11% of revenue, and iPad contributes the remaining 8%. Now on to the recommendation. So at current levels, we see the shares fairly valued. Although on a forward PE ratio basis, it is ahead of its long-term average, it's still in line with the market, which we believe is justified. For the next full year, the market is anticipating strong earnings growth from the business in the rounds of around 24%. This is due to the combination of new product launches, being the iPhone 8 and iPhone X, renewed momentum in China, which showed strong trends in the fourth quarter of 2017, and an improvement in the gross margins, driven by a strong growth in the higher margin services business and higher average selling prices as the newer launches are more premium products. As I highlighted earlier, the main concern in this business is the competitive forces faced in the mobile phone business, which is Apple's largest revenue stream. This risk comes from the short product life cycles and technological change. However, this concern is alleviated by the higher switching costs from the integration with Apple's own software and other products, whereas Android is the operating system for many other devices. Apple also has a good track record of delivering devices that resonate with consumers, which has enabled them to build a premium brand. Although this does mean that should there be any serious faults, either in their hardware or software, it could have a material impact on the business, diminishing the premium pricing that they are able to attract. They also continue to invest heavily in research and development, although we don't necessarily see this as a differentiating factor, but it is essential to maintain competitiveness. One of the newer technologies is augmented reality, or AR for short. This is where your physical or real-world environment gets integrated into the software. We don't believe that the potential upside from any of these newer technologies is priced into the share. This is because it's very difficult to estimate the potential. Therefore, this does provide positive optionality should it be taken up well by consumers. This slide shows a relative valuation of Apple to its competitors. By the GICS classification, Apple is seen to fit into the technology hardware industry. This is also where you'll find Samsung. Although these businesses are inherently consumer focused, they generally trade at discounts to other businesses in the consumer sector. This is because there's less certainty that the earnings from these businesses will be recurring for the reasons that I mentioned earlier. Looking at Apple, the share is trading at a forward PE ratio of 15 times, slightly below consumer peers of 16 times. This is a narrower discount to the consumer sector than its other technology peers, which is something that we would expect to see, given that they have been successful in increasing the cost for a customer to change to a competitor's device by integrating them into the Apple ecosystem. The chart on the right-hand side shows how the discount that Apple trades to the consumer sector has narrowed over the past 2 years. We believe that this highlights the success that they have had in building out this ecosystem. Now onto the financial review. Just as a note, I'm going to be discussing these results for the full year 2017 unless I say otherwise. Net sales was up by 6%. This was driven by strong performances achieved in services, iPhone and Mac. Services accounted for approximately 41% of this growth, and this is definitely the area that we would like to see strong growth in. The results were, however, adversely impacted by weakness in foreign currencies against the US dollar. The gross margin declined marginally to 38.5% from 39.1%. This was impacted by higher product costs, although partly offset by a favorable shift in the mix to services. The operating margin declined by 1 percentage point to 26.8%. This is a larger decline than we saw in the gross margin, as operating expenses were 11% higher for the year. The main driver behind operating expenses was research and development, which increased by 15%. Net income was up by 6%. However, diluted EPS was up by 11% due to the ongoing share repurchases as part of the group's capital return plans, which ultimately resulted in a lower number of shares. For the full year, dividends totaled 240 US cents, reflecting an increase of 11% over the prior year. Looking at the revenue per geography, the Americas delivered the strongest growth of around 12%. This was followed closely by the rest of Asia Pacific. Europe grew by 10% and Japan by 5%. Greater China was the only region to report a decline, although there was good momentum in the fourth quarter, as I mentioned earlier. The group also achieved revenue growth in excess of 20% in emerging markets in the final quarter. Now looking at the divisions, starting with iPhone. Net sales rose by 3%. This was driven by a different mix of iPhones, which ultimately resulted in higher average selling prices, as well as a 2% increase in unit sales to 217 million units. During quarter 4, double-digit iPhone growth was experienced in mainland China, the Middle East, Central and Eastern Europe, India, and Mexico. iPad's net sales fell by 7%. The decline reflects a combination of a 4% decline in unit sales, as well as a negative sales mix, which resulted in lower average selling prices. However, the business did show good momentum in the final quarter, particularly in emerging markets. Industry figures also showed that iPad gained share in the US tablet market, with a market share of 54% in the fourth quarter, compared to 47% in the same quarter the year before. Focus for this business has been to entrench their product in the enterprise market through the Internet of Things. For those of you who are not familiar with this term, the Internet of Things simply refers to connected devices. An example of this would be a smart coffee machine that you can access through the Internet. They did gain some traction through partnerships with Accenture, a large business consulting firm, and General Electric, which is a large industrial conglomerate. Moving on to Mac, the business delivered a strong performance with sales up 13% through volume growth and higher prices. The fourth quarter was particularly strong, where unit sales grew by 10%. This was in a market where unit sales were down by 11% according to the International Data Corporation, or IDC. The strong growth was aided by the education market. Services achieved net sales growth of 23% and an increase in the number of subscribers to 210 million from 195 million at the end of the third quarter. Looking at the App Store, the group has indicated that the new operating system, iOS 11, has been received well by the market. They've seen a rise in the frequency of customer visits, the number of apps downloaded, and the amount of time spent in the store. The operating system has also been received well by developers. They've integrated Core ML, which allows developers to use artificial intelligence models in their applications. Apple Music continues to perform well with strong revenue growth and the number of subscribers increasing by 75%. Apple Pay has grown significantly with the number of users more than doubling and annual transactions more than tripling. This growth has been aided by the entry into new markets such as Denmark, Finland, Sweden, and the UAE, as well as continuing to grow the merchant network with who this service can be utilized. Lastly is other products. Sales was up 16% for the year. Apple Watch continues to deliver strong growth and has seen volume growth in excess of 50% over the last 3 consecutive quarters. Now looking at the company's guidance. iPhone's results are expected to be supported by the recent staggered launch of the 3 new iPhones, being the iPhone 8, 8 Plus, and X. These are all premium products which are sold at higher prices. Management has indicated that they have experienced strong demand for the iPhone 8 and 8 Plus, which have now become their most popular models. The group has also experienced strong growth in emerging markets, which implies growth in new users who could contribute to future upgrades. Looking at their guidance for the first quarter of 2018, revenue is expected to increase to between $84 billion and $87 billion, driven by the recent iPhone launches. The gross margin is expected to improve to between 38% and 38.5%, supported by the growth in the higher margin services business. Operating expenses are expected to rise to between $7.65 billion and $7.75 billion. And the group expects a tax rate of 25.5%, being higher than the tax rate that they realized in the fourth quarter of 2017. Lastly, looking at our portfolio guidance. So Apple is a good quality business. They have an above average return on equity, high margins, and consistently strong cash generation. The business has a very strong balance sheet and a stable earnings profile. However, there is some dispersion in market expectations for the business. In conclusion, we are neutral on the share and recommend an exposure of up to 2.18% of your portfolio. Before I finish, could you please take note of the following disclaimer? And that concludes this webinar. Thank you for listening and enjoy the rest of your day.